Hey everyone, this is Brian from Greater Alliance Digital Marketing Team. We're going to get started in about 3 to 4 minutes, give or take, to get some people to come in. So just hang tight and wait for an announcement for us to begin. Hey everyone, welcome to the webinar. We're going to give people another minute or two before we start the presentation, just to let some people, I know they're running a little late, so we're going to give them some time. Just to let you know that the presentation will be sent, the webinar will be sent to you after in a recording format, just in case you missed anything or you have to get up and go to the bathroom or anything. So don't worry if you have to do something during the webinar, because you will be sent the entire presentation in full as a video recording later on in your email. So again, we're going to get started in about 2 minutes, so just sit tight. All right, everyone, welcome to the webinar about what programs are available for you to qualify to buy a home. This is a very important webinar. It's going to discuss all the various programs that Greater Alliance offers that will benefit you in your search for buying a home and, the process with that. So we're just going to get started here, but before we actually get started with the webinar, I want to show you some resources that are available to you while we're going through this. At any point during the webinar, feel free to ask questions. You should have some sort of prompt on the right side of your screen, and there should be a little area for questions. You can just click down. At any point during the presentation, feel free to ask. At the very end of the presentation, we have a Q&A section that's dedicated for people who ask questions, so we'll have every question answered. There should be one or two handouts within the presentation. They're PDF guides on first-time home buyers or home buyer expenses. These are just additional resources for you to use in case something we missed during the presentation, you want to learn more about the home buying process. I don't believe we have any polls in this presentation, but look for that in future presentations. Those are always fun. And then, like I mentioned before to some of the people who were on, even if you miss this webinar, if you have to get up for any reason, you will be sent a recording in an email form after the webinar is over. So again, don't worry if you had to miss anything, you had to get up, you'll get the entire recording sent to you. And with that, I'm going to introduce today's presenter. So if you're here for the last webinar, it's the same amazing Jasmine. So just another recap, Jasmine has been a certified HUD counselor, housing counselor for the past 12 years and has over 18 years of experience in the housing and mortgage industry. She specializes in first-time loan, LMI, and community development. Jasmine also assists with various grants, including the Savings Match Program and the Financial Strategic Planning. Jasmine is passionate about rebuilding the community and social services and received her degree in business administration from Berkeley College. So with that, I leave it to Jasmine and to introduce the rest of the presentation.
All right. Thank you, Brian. And thank you all for joining us today. As Brian mentioned, this is a very, very, very important webinar, so I'm really happy that you're all able to make it in today to listen in. Please take notes, and if you have any questions, do not hesitate to just make notations of them. I'll be more than happy to answer any and all questions that you may have. So today's agenda is going to include types of mortgages. We are going to speak of FHA Loans, Home Buyer Savings Programs, the HomeReady Program in particular. We're also going to talk about home buyer grants, what you need to be able to qualify for that, CAPC down payment assistance grants, future webinars and events, and as I mentioned, Q&As at the end. So let's just jump right into it. Let's talk about the most common types of mortgages. Now, there are two types of mortgages when we're talking about conventional loans. There is one that's called fixed rate mortgage. Usually this is the one that I always recommend for first-time home buyers, and it's typically because the interest rate is constant for the duration of the loan, and you know exactly what your principal and interest payments will be each and every month for the life of the loan. Now, I particularly said principal and interest payment will remain the same because your mortgage payment may vary depending upon the taxes. So, usually, once you obtain a mortgage, during like the month of November, December, we always send out a property tax assessment to the township where you purchase your home, and depending what your annual taxes are going to be for that year, we will have to adjust your mortgage payment accordingly because, again, that's one of the expenses that will be included in your mortgage payment. So having a fixed rate mortgage, you're going to know what your interest rate is going to be for the life of the loan for 30 years or 20 years, however you decide to obtain your mortgage or for however long. So that will always remain the same. You're going to know at least for one whole year exactly what your mortgage will be, your mortgage payments are going to be. If the interest rate drops, however, you can always refinance to get a better rate. So your rate is always going to be constant. If interest rates go up, then you'll be happy that you locked it in at a lower rate. Okay, so that's one of the benefits. Now, the adjustable rate mortgages. With an ARM, your payments can change over time. So common ARMs are fixed rates for maybe 1, 3, 5, 7, or 10 years. After that, the interest rate will be adjusted annually. So, for instance, let's say that you take out a 5/1 ARM. That means that your interest will remain the same for 5 years, but then every year after that, so for the next 25 years, your interest rate is going to vary. Okay? So that means that your mortgage payment will change depending upon the interest rate. Now, Greater Alliance offers a unique adjustable rate product. So what does that mean? That means that we have a 5/5/30. Okay, so 5/5/30 means that for the first 5 years, your interest rate is going to remain the same. Now, after the 5 years are up, depending on where the market is, so let's say interest rates are a little bit higher. Okay, right now there is an error with the webinar, so I'm just going to be speaking about the fixed rate benefits and drawbacks.
What?
How do you put that?
You can press the arrow here.
Just bear with me one moment.
Hold on one second, guys. The presentation froze for 1 second, so we're going to see if we can get it back up and running. If you want the paperwork, you can speak to it. I'm going to try logging in here.
All right. So let's talk about the 5/5/30. It indicates how many years the initial fixed rate will be set for. So the first 5 years, as I mentioned, it will remain the same. It will probably go up or down. Your interest rate will probably go up or down depending on what the interest rate of the LIBOR index is that month that the your mortgage payment is due to adjust. And then it'll remain fixed for another 5 more years. So the 5/5, so the first 5 tells you how many years is going to be fixed for, and then the other 5 tells you how often the interest rate will be adjusted thereafter. Okay, so the ARM that we do provide with, okay, thanks. It gives you a cap rate of 5, all right. Perfect. All right. So it gives you a cap of 2%. So the most that it can go up by is by 2%. Also, with the Greater Alliance 5/5/30 Max, it'll the lifetime of the loan it'll go up to by 5%. So meaning every 5 years the interest rate may vary. Okay, it can probably go up or it can go down. Then it'll be fixed, and then again it'll adjust in another 5 years. So you're going to be able to take advantage, at least for a very good rate for the first 10 years. Okay. At that point, you can also refinance. There's no prepayment penalties. Now, the benefits of the fixed rate, okay, no, it came back. Okay. So the security of a predictable monthly payment over a long period of time, that's one of the benefits, and you're protected in a rising rate environment. So let's just say, for instance, you close with a 4% rate, and let's say during the first 5 years, the interest rates remain the same, but then they go up to maybe a 7%. You have nothing to worry about because your rate will not go up, nor will it go down. Okay, it'll just remain the same for the life of the loan. The drawback is that the interest rate is generally higher. So the borrower's rate will not drop with the market unless they refinance into a new mortgage. Meaning, the difference between the adjustable and the fixed rate. With the adjustable rate, your rate is probably lower by 1%, I say. But again, remember that the rate will remain the same for a certain amount of years. Like with our 5-5-30 product, it'll remain the same for 5 years. With a fixed rate, maybe your rate will be a 4%. So your mortgage payments are going to be slightly higher. Okay, but again, you'll have that ease of mind that your rate is not going to go, it's not going to adjust once again. So adjustable rate benefits and drawbacks. The benefit is that the interest rate is usually lower than the fixed rate. Like I mentioned, it may be a 3%, maybe 3.125. And there's always a chance that the rate will go down. If the rate goes down, then that means that you can benefit from that and your mortgage payments will drop. Now, the drawback is that you may experience a payment shock if the interest rate goes up to, let's say, for instance, from 3 to 5%. So if the mortgage payment increases too much, then you may need to refinance if you can't afford the potential increase in rate. Okay. Now, usually when it comes to these adjustable rate mortgages, I will recommend a first-time home buyer to consider it if your goal is to possibly sell the property within 5 years. If you're just looking to live in the property for 5 years, and maybe you're looking into getting yourself into a bigger home, or maybe into a two-family home, or you're probably thinking about moving out of state, then an adjustable rate would be the best product for you. Again, only because why pay more interest when your intentions are short-term with the property? So maybe that's a product for you to consider. All right. So let's talk about conventional mortgages. All right. In order for you to be able to qualify for a conventional mortgage, the advantages are that you need to have a good credit history and is looking for a favorable loan. So if you're looking for, if you're going to present, let's say, for instance, a pre-qualification letter and you have a conventional mortgage, it's typically, the seller will typically take your offer into consideration more than someone else that would have maybe an FHA mortgage. Usually you have more than 20% equity in their home and is eligible for PMI and can put at least 5% down on a home purchase of a new home. So typical conventional mortgages, you will have to have 5% down payment. Okay. Now the drawbacks is that you have less than stellar credit history, so that means that you may not qualify for a conventional mortgage. You have less than 20% equity in their home and you're not eligible for mortgage insurance. Also, you're not eligible for PMI or cannot put at least 5% down on a purchase of a new home. So this next presentation is going to talk about FHA loan information and what's the difference between FHA and conventional mortgages. I know that you've heard this word a lot, and typically this is the type of loans that mortgage servicers would want to push first-time home buyers into. Why? Because FHA mortgages are costlier, and we're going to talk about a little bit about that in a few minutes. But what is an FHA? The FHA is a Federal Housing Administration. That's what the FHA stands for. It provides mortgage insurance on loans made by FHA-approved lenders. So FHA mortgage insurance premiums. This is something else that you probably heard of. Most FHA mortgage loans require an upfront mortgage insurance premium and an annual mortgage insurance premium, which is paid in installments over 12 months. The monthly payment is considered part of your monthly mortgage obligation. So let me give you an example of that. So typically with an FHA mortgage, you always have to consider that you will have to pay at least 1.75% more of whatever the loan amount is. So let's just say, for instance, that you find a home and the home is $250,000. So if you multiply 1.75% of that, that's 4,375. Okay, so that's usually an upfront MIP, which will be added to the $250,000. So that means that you will have to, the new purchase price will be $254,375. So that's something that you will have to take into consideration. In addition to the upfront MIP, you will always have mortgage insurance as well, which is PMI. And that's going to be calculated into the mortgage. So let's just say PMI will probably be, depending on your credit, it can cost you maybe $180 to maybe $250 more on the mortgage payment. Okay. FHA payment requirements. Usually we go by the 12-month rule, which means that if you're thinking about obtaining an FHA mortgage, it's important for you to start doing the right thing. Or, if you're thinking about maybe purchasing a home in 12 months, just make sure that all of your bills are paid on time. So what do I mean by that? That means that you will have to pay your rent on time, let's say your car insurance on time, your cell phone bill on time, because the 12-month rule is that when you're going through the FHA loan application process, at times we would require some time of good payment history. So all of your payments have to be on time for all financial obligations, everything. So it's always important for you to make your bills on time, besides your credit cards, your car payment, and everything else that's being reported on the credit. Mortgage loan amount rules. There's no cashback on forward mortgages, or purchase loans can be made only for the amount of the mortgage plus an approved add-on to the loan amount, which is the upfront MIP on certain closing costs. So that really doesn't really come into play unless you want to add, let's say, for instance, a seller's concession on top of that, which we're going to talk about in a few minutes, or the upfront MIP, which is something that you will have to finance as well. Okay. Minimum down payments for an FHA mortgage, it's typically 3.5% of the home value. So that would be your down payment. So remember when we were talking about conventional loans? Conventional loans are typically 5%, but with an FHA, you can put 3.5% of whatever the purchase price is. And also with an FHA loan, you will have to live in the property as your primary residence. So FHA loans are for new purchase mortgages, one-time closed construction loans, 203K loans, which unfortunately we don't offer here, but those are rehab loans, and others require the borrower to be an owner occupied of their own of the property secured by the FHA mortgage. So if you're thinking about purchasing a home with an FHA loan product, remember guys, you will have to be living in the property as your primary residence. Now, the FHA or Federal Housing Administration provides mortgage insurance on loans made by FHA-approved lenders. Not every lender has this product. FHA insures these loans on single-family and multifamily homes in the United States and its territories. It is the largest insurer of residential mortgages in the world, insuring tens of millions of properties since 1934 when it was created. So we're going to enter into what are the requirements, what are the things that we look for when approving you for an FHA loan. So typically your credit score has to be at 620. With a 620 credit score, you can put 3.5% down. Now, we also accept scores as low as 580, but if your credit score is at 580, you will require at least 10% down. Okay, so I typically don't recommend to move forward if your credit score is at 580. If you have room for advancement, if you have room to be able to increase it, I would suggest for you to do so, only because a conventional mortgage would be a better way to go, and we're going to talk about that also in a few minutes. Now, with an FHA mortgage, it will allow you to have a 6% seller's concession. Now, many of you are saying maybe, what is a seller's concession? So let me explain it to you with numbers so that it can be easier for you to understand. So let's just say that you found a home and the home that you found is for $250,000. At 6%, that means that there is $15,000 that you can use towards down payment and closing costs. So as opposed to your purchase price being $250,000, this is something that the seller will, have to consider and approve you for. So the seller says, okay, you know what? I'm going to help you with the closing costs. Let's increase the purchase price to $265,000. Now, at the closing table, the seller will still walk away with $250,000, but $15,000 will go to your closing costs and down payment. So that means that your new loan amount will be $255,725, because remember, you still have to put the 3.5% down payment. Okay, so seller's concession, once again, is when the seller will authorize for you to include a certain percentage. It can be 3%, 4%, depending on the value of the home, to be used towards your closing costs. All right. Number 3, MIP requirement. That's the mortgage insurance. That is required. Now, with an FHA mortgage, even if you were to put, let's say, 20% down payment, with an FHA mortgage, you will always have to pay the MIP. That's something that will never go away for the life of the loan, okay, regardless of how much equity you have in the property. Now, there is a debt-to-income ratio of up to 50%. Typically, the debt-to-income ratio is about maybe a 46%, but with our programs, it will allow up to 50% debt-to-income ratio. So a debt-to-income ratio is, let's talk about the back end. Let's just say that your income is $3,000 a month. So if you divide 3,000 into 2, that means that you can afford a mortgage payment of $1,500. That includes principal, interest, taxes, homeowners insurance, and mortgage insurance. That's not including any credit cards or car payments if you have any. So I'm just giving you an example of what a debt-to-income ratio is. So again, we do allow up to a 50% DTI. Now, again, with an FHA loan, it will have to be your primary residence. Okay, so it's not a property that you can purchase and then rent out. And you must have steady income and proof of employment for at least 2 years. So if you've been employed for 2 years, then you can move forward with a mortgage. But let's just say you've been employed for the past 6 months with one employer, but then prior to that, you were at another employment. You can still qualify if it all sums up to 2 years. Okay, so don't get scared. You can still qualify, again, at least if you have a 2-year working history. Now, one of the things that we don't approve you for is if, let's say, for instance, you were going from a commission-based to a W-2. So again, if you were self-employed earning a 1099 or commission-based, and then you decide to switch over to an employment where you are receiving a W-2, then you cannot qualify for a mortgage. You have to have at least 2 years receiving the W-2 or 2 years receiving 1099s. Okay? Now, we are here to help with your home buying, with our home buying programs, and we're going to talk about that. So pay very close attention, and if you have any questions with regards to that, do not hesitate to give us, okay. Do not hesitate to ask any questions, okay? So we have the Home Buyer Savings Program. This is just particularly for borrowers who are not mortgage ready, that their credit score is not up to par yet, or does not have a lot of savings. So this is for borrowers who will need maybe 12 to maybe 15 months to be able to purchase or thinking about purchasing. This would be one of the best programs for you to enter into, because you can double dip with all of our programs. So this is, remember guys, this is one of the biggest purchases you can make, and this is one of the biggest investments that you're going to make, and we're here to help you. Save at least $1,000 with credit towards your closing costs. We did include the website here for more details, but we can talk about it right now. It's in 4 easy steps to start saving and earning your reward. So the first step into saving, going into the savings program is that you will have to move forward with counseling with Green Path. Okay, they're a HUD counseling agency that is going to move forward with counseling you, taking a look at your credit score, and getting you mortgage ready. So you're going to have to sign up with them first, okay, with Green Path first. And then step 2 would be to qualify for a mortgage with us, okay? We'll let you know exactly what your pre-qualification is good for, what's the amount that you can possibly qualify for, what will be your mortgage payments, and possibly other programs that may be readily available to you. At that point, you will then open up a home buyer savings program account here. The minimum deposit that you can make is $100, and you can start saving that for 15 months, between 12 to 15 months, okay? Then at the end, once you find a home, you enter into a contract, and we have a closing date. At that point, you will receive $1,000 credit towards your closing costs on your Greater Alliance mortgage. Okay, so that's one of the programs that we have available. The other program that I'm really excited to talk about is the HomeReady Program. Okay, it's with a 3% down payment, and it's a conventional mortgage. So it meets the diverse needs of today's buyers and grow your business with HomeReady Mortgage, or our enhanced affordable lending product. It's designed for creditworthy, low to moderate income borrowers. HomeReady offers expanded eligibility for financing homes in low income communities. Okay. So one of the reasons why you can choose the HomeReady program is because the interest rates are comparable to conventional loans. It has very low down payment, so like I mentioned, as low as 3% of the home value. It has, you can actually tag multiple down payment assistance programs. So let's say, for instance, you qualify for our $1,000 down payment assistance, and let's say the county has $7,000 down payment assistance. We can combine both, and you can have $8,000 altogether for down payment assistance. So the HomeReady product will allow you to put multiple grants, one on top of the other, to help you with both down payment and closing costs. Also, HomeReady program does offer the reduction in the mortgage insurance. So just as an FYI, with a regular conventional loan, the typical percentage would be maybe 33%. That would be your mortgage, the mortgage insurance payment on a monthly basis. But with the HomeReady, it'll be maybe a 25%. So you can see that there's a big difference as far as the percentage is concerned. Now, the use of down payment and closing cost sources like gift funds and down payment assistance programs are available. So let's say you have a father or mother that would like to give you $10,000, $20,000 to help you with your first home. We do allow down payment assistance from your parents. So that's called a gift, right? As long as you're able to source it, so we can show where the money is coming from. So let's say your mother or father would like to give you $10,000. We at least need to see that money in their account. They will have to provide us with 1 month bank statement and a gift letter, just saying that it's not a loan, that they're gifting this money to you. Okay. Also, with the HomeReady program, you have counseling available for the life of the loan. So it's you can have the counseling before you purchase the home and after you purchase the home, just in case, like, let's say that something happens, either you lose your job or you need to make roof repairs and you don't know what to pay first. The housing counselor will be there for the life of the loan. So you'll always have someone to fall back to, just in case you do have that emergency and you don't know what to do first. What applies to this HomeReady is that the maximum income and loan amounts limits only apply to the state of New Jersey. So if you're looking to buy in Florida or South Carolina, we cannot offer the HomeReady program. The HomeReady program is only for properties in New Jersey. Okay, so if you're interested in this program, you can set an appointment for home counseling, or you can also speak with me and I can get you started with the program itself. So just having a quick overview on the HomeReady program. Again, financing up to 97% loan to value, meaning that you can only put 3% down payment. You don't need to put 3.5% or 5%. It benefits everyone. So the borrower is not required to be a first-time home buyer. Meaning, let's say, for instance, you own a home today and you're going to sell that property and you're going to move into a new home, you're still considered to be a first-time home buyer. Or let's say, for instance, you owned a home last year, you're still considered to be a first-time home buyer. Okay. Now, it has the flexible mortgage insurance. So that means, let's say, for instance, you have about 22% equity, okay? At that point, your mortgage insurance can be eliminated, which in other words would mean that your mortgage payments go down, because that maybe $180 or $200 extra that you're paying for mortgage insurance will be eliminated. Okay, so it's definitely a great feature, and you don't have to refinance in order for that mortgage insurance to be canceled. Just have to give us a call, say, hey, you know what? I have 22% equity. I would like to be reviewed so that my mortgage insurance can be eliminated. We'll do our due diligence to find out and see whether or not you truly have the 22% equity, and then at that point, we'll cancel it. Okay. Also, there's various sources of income. So gifts, grants, and community seconds are allowable. Okay. Extra credit, which is number 5, non-traditional credit is allowed. So meaning, remember I talked about the 12-month history with paying your rent or maybe paying your cell phone, your insurance, that's also allowed. So it definitely makes you look good if you were to have that non-traditional credit. Okay, and it also supports manufacturing, housing up to 95%, and home style renovation up to 95%. So if you're thinking about purchasing a manufactured housing that's fixed to the foundation, we're also able to apply the HomeReady feature to those types of homes. Okay, so again, the borrower's benefits are 97 LTV. You're going to hear that word a lot, LTV. That means loan to value. That means, what's the percentage of the purchase price that you're going to borrow, okay? Flexible sources of funds can be used for the down payment closing costs with no minimum contribution required from borrower's own funds. So this only applies to one-unit properties. Affordable and cancelable monthly MI. So reduced mortgage insurance requirement below 80% loan to value. So if you're going in with 20% equity, 20% down payment, then you don't have to pay mortgage insurance. However, if you've had the home, if you go in with 3% down payment, then you will have to wait at least until you have 22% equity to be able to eliminate the mortgage insurance, okay? And the homeownership course. So you can take the online framework course, which prepares you for sustainable homeownership, or other educational advising options are available as well. We offer the homeownership course for free. So guys, take advantage of it. Through Framework or anywhere else, typically the course is about $150, but going through GreenPath or NaviCore Solutions, and I can provide you with those numbers as well once you're ready, we do provide those services for free through the Address Yourself program. Okay, so we have first-time home buyer grants. So they're basically designed to assist homeowners that have little savings. It can help you also overcome obstacles, help you overcome daunting costs to buy a home, and it'll give you maybe, it's more money back. So eligible members maybe receive between $3,000 to $5,000 towards down payment or closing costs on their first home. So the grant option in itself, it's something that both you and I can go over once you're ready, and I can pre-qualify you. I can take a look and see, okay, you know what, depending on the information that you've provided me with, I can say, you know what, you are eligible for the full $5,000 or $3,000, or if you need a little bit more, we can also try to help you with more. But typically it's between $3,000 to $5,000. Okay, guys? So the benefits of first-time home buyer grants. Obviously the 3% down payment is one feature. The other one is that you need to have at least $1,500 required from your own funds. So if you're going to move forward with the New Jersey Community Capital Grant, which is the one that we were just talking about, between $3,000 to $5,000, you need to have at least $1,500 of your own funds in order to be able to apply for this type of a grant. Okay. You also must complete the free home buying counseling offered through the Address Yourself program. So again, it's something that's for free. It's an hour, and you can do it over the phone. So you don't have to travel anywhere. The grant must be used for a mortgage through Greater Alliance. Okay. And also, it'll provide you with a reduced mortgage insurance. Now, many of you are thinking, are you eligible? Okay, if you can answer yes to the following questions, then yes, you are eligible. So, are you a Greater Alliance member or eligible to become one? So, you don't necessarily have to be a member right now. As long as you become a member before closing, then you can qualify. Are you a first-time home buyer? Okay, do you have a good payment history and can qualify for a loan through Greater Alliance Home Loan? And can you pay your portion of the down payment, right? So you can't just depend on the grant to be able to buy a home, because remember, you also have additional closing costs that are associated to it. And is your income and the total income of all borrowers on the loan less than or equal to 100% of the area median income level? All right, so these are questions that you can ask yourself, and if you can say yes to all of them, then you can apply for the loan. But don't worry, once we go through the pre-qualification, I can let you know whether or not you can qualify. If you're not too sure about the 100% of the area income level, I'll be able to walk you through it. Typically, if you make less than maybe $67,000, then you can qualify for it. So, is your future home eligible for a first-time home buyer grant? So, is the application amount no more than $453,100? So your loan has to be below that amount, okay? No more than that. Is it a condo or a single-family home? Is the home in Bergen, Passaic, or Hudson counties? And will this property be your primary residence with at least 5 years of living there? The reason why we included the 5 years is because if you're eligible for the grant, and let's say, for instance, we do apply to the loan, then you will have to live in the property for 5 years. Each year, 20% of the grant will be evaporated, okay? So let's say you live in the house for 3 years. Then that means that you will have to repay $2,000 of that grant. So it's always important to live there for the full 5 years. Okay, so you can start getting the dream going. You can get pre-qualified, set up an appointment for home counseling, and then you can request a grant from our website, which is www.greateralliance.org/homebuyer programs. Now, let's talk about down payment assistance grant through CAPC. So this is a program that we have for first-time home buyers and for those individuals who are low to moderate income. So we partnered with New Jersey Community Capital, okay, and they have a program through CAPC. So what they do is that we buy a pool of foreclosed properties, and those properties are rehabilitated. So I'm talking about stainless steel appliances, granite countertops, brand new floors, brand new bathroom, brand new walls. So everything is brand new with warranty inside the home. And then we sell it back at foreclosure costs, okay? So it's basically turnkey, this property. Now, in order to be able to qualify for this property, you need to be at least 120% of the median income level, okay? Now, with these properties, with these foreclosed properties, you can apply a $48,500 grant. And those are just for certain properties, not all, but certain properties do qualify for the $48,500 grant. Now, in addition to the $48,500 grant, we can also apply the $5,000 one. Remember the one that we just talked about? So grant funds are available for properties located throughout the coastline counties throughout New Jersey. So that means if the CAPC property is located throughout the coastline counties, we can apply the $48,500 grant to that property that has been rehabilitated. And if you still need additional funds for down payment and closing costs, we can also apply up to $5,000 in grants. Okay, so there are 2 steps to receive the grant, and we will review that in the next slide. So you find this home, right, and you fall in love with it. This is the property that you want to move forward with, and it's the CAPC property. Once you make the offer and it's accepted, the CAPC real estate agent will complete a CAPC demographic survey, and the CAPC will provide the buyer or yourself with a list of lenders who participate with the grant. Obviously, we're one of them, and we're the preferred lenders for CAPC. So it's important to be able, like when you do find the property that you do like, that you provide them with a pre-qualification letter or a pre-approval letter through Greater Alliance so that you can at least get the first look on that CAPC property, and your offer will be taken more so into consideration. Okay, so I wanted to include a list of income levels in here in order to qualify for the CAPC properties. Okay, so you have to complete a homeownership counseling course through the HUD Counseling Agency and provide the certificate to CAPC. And you can also obtain a letter from a HUD-approved counseling agency, which is from Navicor Solutions. Again, we pay for these services. Okay, so the first step, what I would recommend to do is, if you're serious about buying one of these CAPC properties, calling me, letting me know that that's what your intentions are. At that point, I can pre-qualify you for a mortgage, and then I can move forward with a pre-approval letter from us. That's one of the things that they typically look for, rather than a pre-qualification letter. They do look for these pre-approval letters. With the pre-approval letter, I will then refer you over to Navicor Solutions. I'll provide you with the phone number and the person to speak with so that they can income qualify you. So together with the pre-approval letter and the income qualification certification, you can place the offer on the property and you're ready to go. Once they approve your offer, then it's just little paperwork that you would have to give us in order to be able to close on the loan. And again, this will take maybe 30 days to close, 30 to 45 days, because the property is vacant. So the sooner you can provide us with the documentation, meaning like the 30 days pay stubs, 2 years taxes, 2 months bank statements, I can also help you with the application for the $48,500 grant, and is applicable for the other grant as well, for the New Jersey Community Capital Grant. So all of these things, again, we will discuss once we sit down and talk about the pre-qualification, and I'll give you the necessary steps and walk you through this process, because I know that it can become overwhelming, and I'm not saying that, okay, you know what, I'm expecting you to memorize what we're going over or remember in the near future. That's what I'm here for. Okay, you can call me at any time and we can go over this once again. So we do have future webinars. One is going to be on the 20th. Okay, so we're going to talk about the mortgage approval process. And on the 26th, June 26th, we're going to have a realtor here. And he's going to speak about the importance of hiring a realtor and what to watch out for. Okay. Also, I do speak Spanish, so for those of you who would like to go over the same information in Spanish because you feel more comfortable, I also do speak Spanish. There will be a home buyer fair on Saturday, June 15th from 9 a.m. to 1 p.m. Okay, so the home buyer fair is going to be a free one-stop shop to help first-time home buyers become more confident and educated and prepared, so that you can become a prepared consumer. Okay, you're going to meet a lot of people there. There's going to be realtors, a home buyer inspector, home buyer counselor from Navicor, a title company, mortgage loan officers, myself. I'm going to be there. James Goodman is going to be there. There's also going to be a home insurance representative, an appraiser, a real estate attorney, an underwriter. That's someone that you really want to speak to as well. There's going to be 3 workshops, including a workshop with the HUD counselor. She's going to educate you on how to get your finances in order before buying a home, a roadmap to buying your first home, and a panel of discussion. So everyone is going to be on a panel where you can ask any questions or concerns that you may have. So again, it's going to take place on Saturday, June 15th, so just make sure you register from 9 a.m. to 1 p.m. at the Holiday Inn in Hasbrook Heights. And best of all, it's free. So guys, register today so that you can be prepared for your home buying process. All right. Any questions?
So you actually click this down.
the arrow. We have one question. You're going to this arrow up. There's a few questions.
Yeah, there's a few questions.
If you click it, you should be able to.
Okay. If I refinance at a lower rate, will I be fixed at that lower rate if it goes up? So, if you refinance at a lower rate, if you choose the product of a fixed rate mortgage, then no, your interest rate does not go up. The rate will remain the same for the life of the loan, for as many years as you choose to have the mortgage for. So if you choose to have maybe a 20-year mortgage, then it'll remain fixed for the next 20 years. Now, if your intentions are to be able to pay the loan off sooner rather than later, then what I would recommend for you to do is to at least make one extra payment each year, and you can shave off at least 4 years from that mortgage. The next question is, with an FHA mortgage, does it have to be my primary residence for the entire duration of the loan? FHA requires that when you purchase a home, it is your primary residence, but no, it does not have to be your primary for the entire 30 years. So if you decide to move out, just make sure that you rent it to really good tenants so that you can continue to make your timely mortgage payments. That's it. Oh.
I think that's it for the questions.
Yeah, that's it. Any other questions? Don't be shy.
Yeah, and if you have a question that you want answered that you didn't get that asked here, you can always feel free to reach out. Jasmine's contact information was before and will be again. So if you want to reach out, I'm sure she'll have no problem discussing with anybody in more detail. Just click. We actually also have a survey at the end of the webinar. You'll get that in your email. If you fill it out, we would really appreciate it. It really helps us make these webinars a better experience for everyone. And of course, you also have a chance to win a $25 gift card, so it's a win-win for everyone. So we would, again, really appreciate that if you would fill that out, and you'll get that in an email. And then the last thing is thank you for attending. Please follow us on Facebook, Twitter, and subscribe to us on our YouTube channel. Again, you'll get a link of the recorded session where you can view it on YouTube, and you'll also be able to just view it on your email. Here's Jasmine's contact information again in case you want to reach out to her. There's her email and phone number, and there's a link on the bottom if you would like to make an appointment with one of our mortgage experts, which will probably be Jasmine. So thanks again for attending, and if you have any questions, just please let us know. You're always welcome to reach out. So thanks again, and have a great rest of the day. Let me get the mouse. All right, thank you.